In this video, we're going to answer a fundamental question. What exactly are futures and why should you consider trading them? Now, you might already have a rough idea. Maybe you've heard terms like the S&P futures, oil futures, or gold futures. But to really trade them like a professional, you need a clear, simple understanding of what these contracts actually are and why they exist in the first place. Here's the straightforward definition. A futures contract is a legal agreement to buy or sell a specific asset at a predetermined price at a future date. That asset could be almost anything: stock indices, commodities like oil or gold, even interest rates or currencies. The futures market gives us a way to trade these assets without physically owning them. Now, let me give you a quick example. Imagine an airline company. They use a lot of jet fuel. If oil prices suddenly spike, their costs go through the roof. So they can use the futures market to lock in oil prices ahead of time, protecting themselves from any price volatility. Now, on the other side of that trade might be a speculator, someone like you or me, who's trying to profit from the same changes in oil prices. So futures started as a tool for hedgers like farmers or corporations, but now over time, they become one of the most liquid and dynamic markets for traders worldwide. To really understand the importance of futures, it helps to look at where they came from. The concept of futures trading actually goes back centuries. Farmers in Japan during the 1600s were trading contracts on rice. They were agreeing on prices months in advance so that they could protect themselves from swings in harvest supply and demand. Fast forward to the 1800s, and futures markets became formalized in the United States. The Chicago Board of Trade, or the CBOT, was founded in 1848. Farmers, grain merchants, millers, etc., they all used this to lock in prices for corn, wheat, and other crops. They created stability in agriculture, and it also gave rise to speculation as traders realized they could profit by buying and selling these contracts. Today, futures have evolved far beyond agriculture. We trade contracts on stock indices like the S&P 500 and NASDAQ. We trade energy futures like crude oil and natural gas, metals like gold and silver, even interest rates and currencies. The common thread is this: futures provide a standardized, regulated way to trade assets with leverage, liquidity, and transparency. And here's the exciting part. While futures were once the domain of large institutions, the market is now open to independent traders like us. With electronic trading platforms, retail traders can access the exact same contracts that hedge funds, banks, and corporations trade every single day. That means you're not playing a different game. You're in the same game and the same arena as the professionals. The difference comes down to knowledge, discipline, and of course, execution. Now that you understand what futures are and where they came from, let's talk about why so many traders choose them over other markets. Futures offer several unique advantages that make them incredibly attractive, especially for active traders. The first big advantage is leverage. With futures, you can control a large contract value with a relatively small margin deposit. For example, trading one E-mini S&P 500 futures contract might give you exposure to over $200,000 worth of the index, but you only need a fraction of that in margin to enter the trade. This leverage can magnify profits, but of course it can magnify losses too. And that's why risk management is absolutely essential, and we'll be covering that in depth later in this course. The second advantage is liquidity. Futures are some of the most liquid markets in the world. The E-mini, S&P, crude oil, and gold futures trade millions of contracts every single day. Liquidity means tight bid-ask spreads, faster order execution, and less slippage, all the things that matter when you're day trading. Third, futures trading has a level playing field. Unlike stocks where insiders might have information advantage, or Forex where the market is decentralized and often opaque, futures trade on regulated exchanges with transparent pricing and volume. Everyone sees the same order book and everyone gets the same fills at the same prices. Another advantage is versatility. You can trade futures on stock indices, commodities, currencies, even interest rates. That means you can diversify the strategies and take advantage of global trends, all from one account. And finally, there are tax advantages in some countries. For US traders, for example, futures contracts benefit what's called the 60-40 tax rule, where profits are taxed 60% at the long-term rate and 40% at the short-term rate, often leading to lower effective tax rates compared to stocks or options. Now, when you combine all of these, the leverage, liquidity, transparency, versatility, and the tax benefits, you start to see why so many professional traders focus on futures. It's a market designed for efficiency. Now, let's finish this lesson by putting futures side by side with other popular markets like stocks, Forex, and crypto, so you can clearly see the differences. First, with stocks. Stocks are great for long-term investing, but they're less efficient for active trading. With stocks, you're limited by the cash in your account, and the leverage is usually capped at 2-to-1 or maybe 4-to-1 if you're trading on margin. On top of that, the stock market is open only during certain hours, and outside of those times, liquidity completely dries up. Now compare that to futures. You get higher leverage, 23 hours of trading each day, and access to global markets, not just companies listed on a single exchange. Next, let's talk about Forex. Forex offers high leverage and trades 24 hours a day, but it's a decentralized market. That means there's no central exchange and different brokers may show you slightly different prices. Liquidity can be good on the major pairs, but execution quality varies depending on your broker, and futures solves that problem with centralized exchanges, regulated oversight, and transparent order flow. And then we have crypto. Crypto markets attract a lot of traders because of the volatility and around-the-clock access, but they're also unregulated in many cases. Spreads can be wide, and risks like exchange hacks or regulatory changes may make them less predictable. Futures, on the other hand, give you volatility, leverage, and liquidity, but within a well-regulated environment. So here's the takeaway. Each market has its place, but if you're looking for a professional-grade trading vehicle with leverage, liquidity, transparency, and global reach, then futures are one of the best arenas to be in. And now you understand what futures are and why they're so powerful. It's time to go one level deeper. In the next video, we'll break down the structure of a futures contract itself. You'll learn about lot sizes, tick values, margin requirements, and how these details directly impact your trading decisions.
Watch us live every trading day for more.